Okay, we're going to get started today by looking at the S&P 500 like we normally do. Um, First of all, we have a 50-day moving average, which has been super support for the past couple of years. We're down to the 100-day moving average, and we have support there. Um, and we're oversold in a major way. We're at a stochastics of 16. So we have maximum pessimism in the stock market. We have lack of consumer confidence. We have random actions by the president leading to basically a lot of uncertainty in the market, and that's leading to an oversold condition. So we're oversold. Whenever you're oversold in the market, a lot of times uh, you have to look for catalysts and potential reasons why the stock market would go up next. So I think the stock market is oversold. We have a lot of support here at the 150-day moving average, and it looks like we're going to bounce. And we're exiting one of the worst months of the year. You can see based on our monthly stock market returns, February is one of the worst months. So we knew that when we started, um, and it has been a bad month. So March has traditionally been a good month. So um, I think we have green for March because we're totally oversold coming into March. We have historical averages usually allow for the stock market to go up in March. So let's look at, so we have a couple of different catalysts. Number one, NVIDIA is going to have one of their product demonstrations in March. So right now, NVIDIA is super oversold. They had a really good earnings report. We'll talk about it later. But their stock sold off 10% on the news. So last week, I said about NVIDIA's earnings, there was a lot of um, optimism in NVIDIA. And I said the words, buy in the rumor, sell in the news. So if you have a big event coming up in the stock market, such as earnings, and the stock was rallying into earnings going up, a lot of times, even if they actually meet estimates and they had great projections going forward. So both, and they met all of they didn't do as well in margins, um, but it was a very good earnings report. But they sold off in the news. So that's called buy on the rumor, sell on the news. We'll go over NVIDIA's financials a little bit later, but they're oversold right now. And a lot of times when there's maximum pessimism in the stock market, right now we have extreme fear. And whenever you have extreme fear, a lot of times you have a snapback rally, especially whenever you're in a trading range in um, most of the stocks you're following. Let's look at our stochastics in in all of our ETFs we're following and all of the stocks we're following. You can see by the S&P, we are definitely oversold. And this is like a perfect time to dollar cost if you're not in the stock market because we're oversold and we're at the bottom of our trading range. Let's look at every major ETF we're following is oversold. We're at the bottom of our trading range and we're going into one of the best months of the year, historical. Let's look at ETF, the defense ETF. It's hugging this bottom of the line of our trend line. We're oversold. Um, this one is overbought. We have a gold overbought here, so it's not the time to buy gold. You can see stochastics are overbought. We have another one. This is consumer discretionary. Stocks like Tesla and Amazon are big in this ETF. And you can see it's oversold and right with all the other major indexes. Let's look at materials. They're oversold and at the bottom of their trading range. Um, Communication sector. These are stocks like Facebook and Google. They are hmm, they're oversold also. Let's look at healthcare. Healthcare is actually overbought. Healthcare is actually one of the best performing sectors this year. We talked at the beginning of the year how healthcare was unloved for 2 years in a row, and the earnings projections actually for healthcare companies are going up 20% this year. So this could be leading to like a breakout right here. I'm thinking this could be um, one of the best. We said in January, December that healthcare could be a surprise good sector this year. But it's actually overbought right now. You can see that. And a lot of times we do have a lot of uncertainty in the stock market. And whenever there's uncertainty, investors go towards companies, they gravitate towards companies that are safer, that pay a dividend, and there's steady demand for their product in good times and bad. We got some hints this week that the economy is not doing that well, and we might go into a recession. And because of the government spending is being cut back. It seems like if we go into a recession, a lot of times consumers, um, healthcare stocks, stocks that are going to have a steady demand in good times and bad are going to do the best, that pay a dividend also. Telecom companies, companies that are very conservative. So now let's look at the next one here. This is industrial select sector, industrials. That's like Caterpillar, a lot of John Deere companies that do industrial like serve products. They're oversold also, very similar to S&P 500. So we're actually at a point, we're still in our trading ranges for almost every one of our indexes. Um, if we see some of these stocks, I mean indexes trading out of this range, then we might be gearing towards a downtrend. But we're holding up at the 150-day moving average on most of these ETFs, which is very positive for stocks going up. Let's look at the consumer staples ETF. This is like Procter and Gamble stocks that have Colgate, that have a steady demand for consumer um, things that you have to buy. And they're overbought right now. So there's a high demand for stocks with a dividend and they're safe right now. Financials, they're halfway, they're at 28, so they're a little bit oversold right now. And they're halfway between their trend lines. So that's not really anything to do buy or sell for this trade. We knew at the beginning of the year that Trump's deregulation would help the financial companies, and almost every financial company we're watching is doing extremely good this year. Let's look at um, utilities. Um, they're overbought right now. That's another example of a stock or a sector that's high demand. They have low um, volatility, and they're safer. They pay a dividend. So we have fear in the market right now, and this is another example of a safe sector. Real estate sector is one of the best sectors so far this year. Um, Primarily, we have declining interest rates. Let's look at the 10-year. There it is. The 10-year, the 10-year Treasury from America. You can see that what's happening is as the 10-year is going down, we know that that's good for all interest rate related plays in the stock market, but you can see the interest rates, I mean, the S&P is going down with the interest rates. It seems like there is the Atlanta Fed came out this week with an estimate of GDP, negative GDP growth in the first quarter. So if there's a contraction in the GDP, that means the economy is slowing and interest rates will go down with that. And that's not good for the stock market. So we have a brand new dilemma here is slowdown in the US economy means um, it means that the stock market could go down if there's a recession. And that's why stocks were kind of scared this week and went down a little bit. So let's look back at our stochastics. All right, so real estate is probably doing better because interest rates are going down. And if the economy is doing worse, the interest rates will continue to go down. And that was a stated desire of the president. He said, I want interest rates to go down 10, on a 10-year. So he's going to do whatever it takes outside of telling the Fed what to do to lower the interest rates. And I think what's happening is by reducing government spending, that's that's making the interest rates go down because the economy is slowing down. All right, so that's not good for stocks. If that continues, if the interest rates continue to go down and the GDP estimates continue to go down and are negative, the stock market most likely is going to correct, and that's not good for stocks. Let's look at some more of these ETFs. Energy is continuing to go down. It very well could be because the president is enacting some oil-friendly moves, such as allowing oil companies to have permits to drill more oil. And if that happens, the price of oil goes down and the price and the energy companies won't make as much money. So we're going to watch this sector. It's been out of favor for multiple years. And it is a safe sector that pays a dividend, but we don't have any control of the price of oil, and we have no idea where the price of oil is going to be because it's totally random. Um, it's unpredictable, and there's a lot of variables involved that we don't understand. Um, okay, and the global uranium ETF is oversold, and it's at the bottom of its trading range. So we have across the board, this is an awesome time to dollar cost into the market if you're not involved in the market right now. I'm not saying that it can't go lower than this, but if we see breaks or from these channels, all these charts that we've been drawing for the last couple of years that have been in uptrends, all that goes away. You can throw it all away, and then we got to start over again in a downtrend. We don't want that to happen, but we're oversold right now. And if we're continuing in this uptrend, then it's a good sign for a lot of these. A good sign that right now it's a good time to buy. We can see that AbbVie is an example of a drug stock that is overbought. A lot of the healthcare stocks are overbought. You can see the stochastics are 88. It's not a good time to buy that one. You can see Abbott Laboratories is off the charts also. It's one of the best performing stocks this year. It's a healthcare stock also, and it's overbought at 90. Um, Google, you can see that it is at the bottom of its trading range, and it is oversold at 2.99. This is the lowest I've ever seen Google on the stochastics. So you can see that it's super oversold. It's one of the least expensive. Its PE ratio is very low compared to other Mag 7 stocks. So if you don't own Google, this could be a good time to start buying a little bit. Altria, this is an example of a stock that pays around 8% dividend, and it's a safe stock that people gravitate towards in times of uncertainty. And you can see it's halfway between its overbought and I mean its trend lines, and it's overbought right now. A lot of the dividend paying stocks are overbought. Amazon is still in an uptrend and it's at the bottom of its trading range and it's oversold like the stock market. So we have across the board, we have a lot of fear. We have a lot of stocks oversold and um, we have a lack of confidence in the stock market. And that's a lot of times contra trend rallies happen in whenever all these come together. I'm not saying they can't go down from here, but until these trend lines are broken, we're still in an uptrend. So right now we're at 94 on Apple. It's very overbought. Um, AT&T, example of a very secure 8%, 7% yield, and it's in an uptrend at the top of its range. It's not a good time to buy it. It's overbought. And let's go through some more stocks. These are boring. Let's look at Meta. Meta is up like 15% this year. You can see it's oversold right now. It's down to 20 in the stochastics, and it's um, it's right in the middle of its trading range. So, but it's hugging the 150-day moving average. No, the 100-day moving average. So that is really good because that's been support all the way back for years. So this probably could be a good time to buy starting the dollar cost in the Meta. This JP Morgan example of a financial that benefits from deregulation and lower interest rates. So they are super overbought. Not a good time to buy JP Morgan, and they're at the top of the range. It's quite the opposite. You want to buy JP Morgan when it's down here and it's oversold. Um, Microsoft is oversold and it's still within its trading range. It's going sideways, primarily because it's pretty richly valued right now and it's not growing a whole lot. Um, and it's oversold. So, this could be a good time to buy Microsoft if you're interested in it. Um, let's look at some more interesting. Procter and Gamble, they pay a dividend. They're a consumer staple, and they're going to be if we have a huge crash in the stock market, or if there's uncertainty and there's continuous issues with tariffs, we have a stock here that's paying a dividend. And it's in an uptrend. It's in a safe sector, and it's overbought right now. It's not a good time to buy it. Let's look at some more. Okay, just an example of a dividend-paying stock, Verizon. It's at the top of its range and overbought. Not a good time to buy that one. Visa is a financial. Um, it'll benefit from deregulation and probably a new administration is not so hard on monopolies. It's overbought right now, like all the other dividend-paying financials. Um, Waste management is interesting. It has been in a trading range for about multiple years, and it's breaking out just a little bit. I'm not sure exactly why, but the good thing about waste management, if there is a recession and if there is a slowdown in the economy, the amount of trash that's made in America doesn't change. I guess the biggest factor for trash in America is whenever America does construction. If there's big construction projects by the administration, then there's a lot more waste. But this could be a, a very safe stock to buy and hold through hard times. It pays a dividend also. And they're a duopoly with Republic Services. Um, okay, Amgen, it's going sideways. It isn't really doing anything. It's like halfway between overbought and oversold, and in between the our trend lines. Let's look at Walmart. Walmart continues an uptrend. It's a safe, relatively safe stock. Good companies like Walmart, if there are tariffs, they immediately change their supply to get a maximum result. So they'll be able to adapt to any situation with tariffs that come up. So that's why it continues to be bought in this environment. They pay a dividend and they benefit when people are strapped and the economy is not doing so good because people gravitate towards cheaper options and they shop at Walmart. All right, so let's look at Berkshire Hathaway. You can see it's in a relative uptrend. We're halfway between overbought. There are two trend lines, and we're super overbought. They just had a really good earnings report, and they're amassing amazing amount of cash. They have like 300 to 400 billion dollars in cash. So if there is an economic downturn and companies are struggling and the stocks go down in the stock market, this is one of the safest stocks that you can own because they will take advantage of that situation and buy stocks with the huge cash hoard that they have. And on top of that, they are so diversified, most of their companies that they own are in America. So they're not as affected by the tariffs as other companies might be because they sell most of their products in America. Actually, yeah. So let's look at MasterCard. Chart is very similar to Visa. You can almost overlay it with Visa and it'll be almost exactly the same. They have a duopoly with Visa, and Visa and MasterCard have 73% of the worldwide or more of the worldwide credit card transactions. And the theme for MasterCard and Visa are, um, I'd say there's like 90% of transactions in the world are still done with cash. So there's a gradual transition across the whole world to using credit cards. Um, so that's one reason why both MasterCard and Visa are growing at 10 to 20% a year still. Um, eBay, you can see it's oversold and it's at the bottom of it. It's halfway between oversold and overbought in the stochastics. Let's look at Tesla. We mentioned almost every week that Tesla is overvalued right now. Um, and right after the election, we knew right here that Trump won. Um, Tesla went up exponentially here, like in a straight line, but it didn't have anything to do with the earnings. It was just basically based on the idea that Trump and Musk are working together, and that could help Tesla. But right now, the earnings are not very good for Tesla, and they're not, um, and they're overvalued. So this is still, even if even if it's oversold, which it is right now, it's still it's at its 200 no 200-day moving average, which is been support for this stock for going back pretty long time. So we're like an inflection point right here with Tesla. Um, we'll go over a little bit about Tesla later on. Um, Eli Lilly is in a sideways pattern. They're growing at 30%, but they're still just a little bit overvalued. We'll go over Eli Lilly later on today. Um, and they're overbought with all the other healthcare stocks. So it's not a good time to buy Eli Lilly. Let's look at Costco. This is like an indestructible. This stock is just keeps going up, and it's three times overvalued, it seems to me. But it still goes up because they have in bad times, let's look out if there was a recession and the stock market and the economy goes down, and we have recession, people are going to gravitate towards Costco because they're going to want to save some money, and they have a 90% renewal rate on Costco memberships, and that's where they make most of their money. So um, until this stock breaks this trend line, then we still have until it breaks that trend line, we still have an uptrend. And I guess if you're interested in buying the stock, you want to buy it when it's at the bottom of its trend line and oversold, like right here. Right now it's oversold, but hmm, you have to watch these trend lines. If it goes below the trend line, then watch out. T-Mobile, this has been one of the best performing stocks this year that we're following. Um, you can see that T-Mobile US is actually most of their money is made in America. So there's no tariffs problems. There's no issues with foreign governments. It's all United States based, and they're eating the lunch of AT&T and Verizon. They're actually bigger now than AT&T and T and Verizon, and they have the best commercials, and they're giving away iPhones, um, and I think they have the best network right now too. So it looks like they're unstoppable, but they're overbought right now. You can see they're overbought. Not a good time to buy this one. You have to wait for it to get to right here and right here. Um, okay, hold on for 1 second. Okay, so okay, let's go back to our talking points here. Okay, so okay, we have the 10-year down 5% this week, which is pretty big. There's a big concern right now that the economy is slowing and we're going into recession. And if that happens, um, it the worse the economy does, the more interest rates are going to go down. So that could be why the interest rates are going down. I'm not sure. The S&P is down 2.5% this week. Um, we're just ending one of the worst months of the year, and let me see. We have what else do we have to say? We do have a lot of uncertainty in the market. We have tariff talks. On Friday, Trump said that we're going to add and double the tariffs on China, which totally disrupts the business models of almost every company in America. Um, we have this talk about Trump and the Ukraine president in the White House and Trump siding with Russia. That could be like a major market moving situation. Um, and we're making enemies with Europe. So I don't know what's going to happen. It looks like the world's going to be against us and we're not going to grow our GDP as much. That's what it seems like to me. Okay, we've been having this theme since the beginning of the year. Revert to the mean. Healthcare, telecom, financials, energy, utilities, biotech did the worst last year, will do better this year. Return to the mean. S&P 500's PE is large and over time will revert to 15. Okay, so that's actually what's happening right now. We'll go back and look at some of the top performing ETFs, but the stock market's scared right now. We have a lot of uncertainty, and they're gravitating towards these sectors, which are very safe. They're safer. Let's look at some. Okay, we already talked about how almost every one of our ETFs we're following is oversold. So in general, this is a good time to dollar cost into the market if you're not in the market already. Um, and let me see. Okay, we don't have any major changes in our variables in the stock market. Um, the price of oil hasn't changed at all. We haven't had a change in inflation. The dollar's up just a little bit, um, but you can see, and gold is up just a little bit too. But you can see from this chart, the dollar is starting to go down. So as the dollar goes down, that is really good for some of the big tech stocks and companies that do business overseas. So as the um, as the dollar index goes down, the profitability of the S&P 500 average stock goes up. So I'm actually rooting for the dollar to go down. Okay, let's look at the fear and greed index. We're at extreme fear now. So we have, when you're investing, you have to think as a contrary investor. And whenever people are extremely fearful, you have an oversold condition. In extreme fear, you have to think it's time to either hold your nose and buy or don't sell. And we don't know if this is a bottom, if we're done selling, but um, if we stay within our ranges that we've been mapping out, then it's probably a good time to start dollar costing in or don't sell. Um, so we're at extreme greed. No, we're extreme fear. Um, so we're at a we haven't had a bearish 60% in this American Association of Individual Investor survey for a long time. So the average investor is super bearish and they're scared. Um, so we have to interpret that as a contrary investor, it's time to buy or don't sell. Um, so this is we get a lot of indications now that, as contrary investors, it's time to look at possible catalysts that could make the stock market go up. So let's look at our calendar to see if we see any catalysts. We have Fed meeting dates in 2 weeks, 3 weeks. We have a triple witching, which is options expiration, where there's extreme volatility, and we have end of quarter window dressing. So those are three things that could happen. We do have an NVIDIA um, presentation of their new products in the mid-March. So that could be a catalyst for interest in the AI trade. Um, April, the only thing we have is a holiday in April 18th with Easter, and then we have Fed meeting date again on the 30th. So not a whole lot of earnings related activity in the next couple months. We have to wait 3 more months for earnings to come out again, 2 more months. Um, all right, so let's go back to our talking points, what were we talking about? Okay, all right. We're looking at next at the VIX. The VIX is getting higher. It's at 20. So translation of 20, we're getting some fear coming into the market. Um, one of the okay, next thing is we're we've gone beyond fear into extreme fear. So we're afraid of tariffs. We're afraid of the uncertainty of having a possible recession and companies possibly slowing down because of um, lack of government spending. So what other things? Okay, so we already know on Friday we had a random Trump action where he's doubling the tariff on China. And all of these things could lead to a crash. We could have Magnificent Seven stocks correct in some way. We could have NVIDIA's earnings came out and they were good. Um, but there's a lot of people in this stock that could be triggered to sell because of options expiration, etc. Um, okay, let's look at our first to worst. Our best performing sectors this year and the worst. The worst is consumer discretionary and IT, believe it or not. The best are healthcare, financials, consumer staples, real estate, materials, and energy, utilities. These are all stocks that are very conservative. And that was kind of almost perfectly mapping out to our beginning of the year projections. So our first to worst, we've been following, these are the worst performing sectors last year. And we were saying what was worst last year could be first this year. And look at this. We have 8% for healthcare, the best performing sector year to date. Then we have consumer staples. These are all the worst performing last year. And with the interest rates going down and Trump's adamant about lowering the 10-year interest rate it seems like real estate is also going to be doing good. Okay, the financials are also doing good, and the worst performing is consumer discretionary and QQQ. So this is actually coming to pass, believe it or not. And okay, so at the beginning of the year, we were saying investors will be reaching for stability amid chaos. So let's look at chaos right now that I'm worried about. Right here, we've had almost every day we have stock futures plummet after Trump imposes sweeping tariffs. That was a month ago. Trump says he will announce 25% steel and aluminum tariffs. That was 2 weeks ago. Trump said this was this past Friday. Trump says U.S. will impose an additional 10% tariff on China. That is huge. There are stocks like Dollar Tree that are almost totally dependent on China for their goods. And if they have a 10% tariff, that's going to make every one of the things they import 10% more expensive. Um, and they still have to keep their costs at $1.25 for the goods they sell. So anyway, this totally affects every company in America, and it makes it their earnings kind of unpredictable. So let's look at okay. So that was a good little exercise. Um, okay, we're done with this sector performance. Let's go look at some of the sectors that have. Okay, well, first of all, let's look at the context. The context is interest rates are going down in a major way in the last month or so. So let's look at our cheat sheet. When interest rates are going down, yields of the 10-year going down. Positive for small cap, high yielding, home builders, speculative, and REITs. Negative for large cap, stocks, financials, banks, insurance companies, and insurers. Let's look at that happened. Um, Market movers. We see the top performing stocks are involved with the AI play. We have energy company, Edison. Um, we have, oh man, it's changing. AES is an energy company. We have Akamai Technologies. They do software for data centers. We have NVIDIA, of course, makes chips for AI data centers. The top decliners are, we have a lot of renewable energy companies. We have First Solar. Um, we have Enphase, renewable energy. Okay, so it seems like um, this could be a political thing where Trump could be taking away some of the money for some of the renewable resources and putting it towards oil. Um, all right. So Dell had a bad earnings report. They didn't have as good prospects for AI as they wanted. Let's look at some of the Nasdaq's ups and downs. We have a lot of AI companies. Tesla is an AI company. NVIDIA, of course. We have a lot of companies that supply the AI infrastructure and semiconductors. Datadog, they're a provider for cloud. They're a software provider in the cloud. And okay, so the top decliners, PDD Holdings, they are a China company that does Temu. We have mm, we have some semiconductors, and mm, I don't see any theme there. Okay, that's a good little exercise. Sectors going up and down. Okay, so we have financial sectors. Um, we said at the beginning of the year that financials will be probably one of the better performing sectors this year. We have consumer discretionary, we have energy, banks, utilities. all these pay high dividends. So you can see, except for semiconductor, we have financials, they pay high dividends, consumer discretionary, they don't. Energy pays a large dividend. We have banks pays a dividend, utilities. So this is like a fear trade, not a fear trade, but it's a safety trade. A lot of people are going into safer sectors. Um, Ones performing the worst are home construction, um, telecom, miners, trust, real estate. Okay, we can't get anything else from that. All right, let's look at some of our talking points. Dan Niles, let's look at his returns from last year's picks. Meta is up it's almost doubled since when he said to buy it. KWeb is up 30%, Amazon up 46%, Texas Instrument only 21%, and XBI has been a dud. It has not made any money in a year. That's probably because um, biotech stocks aren't profitable. And it seems like what's happening right now is stocks that have high earnings and they're profitable are doing the best. So let's look at some more things that to talk about here. We have his 2024 returns for his stock picks, 26% for ADTN. We have Cisco up 8%. IJJ, not a very good sector pick for him, only up 1%. The banking ETF only up 6%, and cash is yet to be determined if it was good to have money in cash this year. He's expecting some kind of major correction, and it hasn't happened yet. All right, so okay, so we have the bank stocks doing pretty good this year because they have a low PE ratio, they have a high dividend, benefit from deregulation, and um, there could be a lot of deal making. And so far, they're outperforming. They're one of the best sectors, and he was right on this. Um, okay, so let's go back to this talk. This guy said in October. He said, if Trump succeeds in forcing through mass deportations, Elon hacking away at the government, there will be initial severe overreaction in the economy. This economy propped up with debt, generating asset bubbles, and artificially suppressing wages. Markets will tumble, but when the storm passes, everyone will realize we're on sounder footing, and there will be a rapid recovery to a healthier, sustainable economy. So this could all happen within the next 2 years. And so what I said last week was let's keep an eye on the economy to see if we have any cracks, because we're looking for this markets will tumble, and we got to be ready for that. And we're seeing little hints that there are cracks in the economy. And this story came out. The first quarter is on track for negative GDP growth, Atlanta Fed indicator says. Atlanta, like at the beginning of the year, we had 3.9% GDP estimate by the Atlanta Fed for the first quarter. Last week it was 2.3%, but just this week, Atlanta Fed said will be negative 1.5%, which is a contraction. Um, and a lot of times these numbers are revised, and by the time they give the official estimate, it's like 3%. But we got to keep track of these things because if there's enough hints that the economy is slowing, then this, whatever this guy's saying here on Twitter, might happen. And if we reduce our government spending, then the economy is probably going to go into a recession, if we reduce it too much. Especially if we fire a good deal of the government workforce, because there won't be as much spending and the economy will not be as robust. But the stock market will go down if there's a recession, and there's going to be less spending by people, and people gravitate towards those safer sectors in the stock market. All right. Um, but that also explains why, as the interest rates for the 10-year are going down, the stock market goes down with it. Because if there is a contraction in the economy, what's going to happen is the yield for the 10-year is going to go down maybe to 3. And if that happens, the stock market is going to go down with it, like almost exactly one for one. We don't know, but we gotta keep track of these hints. Um, okay, this is article from Barron's. Booming Nvidia now trades like a value stock. So Barron's thinks that um, Nvidia is undervalued, and they say that the stock's 8.5% decline after earnings makes the opportunity the more compelling for investors. And they're comparing this stock against Apple, which is only growing 4% in the last quarter. So Apple has a PE of 32. They're only growing 4%. That means, hmm, but Nvidia is trading at 27 times, and they're growing 20 times faster than Apple. So they have a lower PE ratio, and um, they're growing faster. I've been saying for years that Apple is 3 times overvalued. It is trading at a premium because it has like a moat and it has steady growth, but slow growth. Um, it very well could go down a third of where it is now, Apple. But NVIDIA, it still has a large runway and they're still growing. They had good earnings estimates. Um, and they're coming out with a new product almost every year. Like they're going to come up with a new GPU unit. Um, let me see. He said that Blackwell Ultra, the successor to Blackwell, is on track for release later this year. So like um, there's a lot of momentum with this stock. It went down. It's going to be very volatile, but it looks like it's undervalued. And this new this new product, Rubin, will be unveiled in March at their next conference. So he's saying it's a big, huge step up, and that could be, I wrote this in, it's a catalyst to the stock market, to breaking out of its downtrend and negative vibes on the stock. So when we look at our calendar, we see, March is usually a good month. NVIDIA is totally oversold right now. And on top of that, we have a catalyst for it to break out of its slump. It has a new products. It's going to be excitement around that. That's how you think about, whenever stocks are volatile. And what I thought would be interesting, let's go over some of the financials on NVIDIA after the earnings were released. We see that the forward PE is 28, and according to Yahoo Finance, it's 22% overvalued at a PEG ratio of 1.2. But their profit margin is 55, and their return on equity is 119, which is off the really good. They have more cash than debt, so that means they don't have to worry about interest rates um, and borrowing money. And they have a very small dividend. It's pocket change. It's not worth talking about. All right, so let's look at the earnings estimates for NVIDIA. We look this year to next year, it's growing at 50%. Um, the year after 27, 13, and 5. Um, no one can predict this correctly, and they haven't been predicting it correctly. Last year, they were saying, 2 years ago, they were saying the growth this year is 25%. So right now, we just have to say they're growing at 50%, even though they're really big. Their PE is 28, so the PEG ratio is 0.56, which is about half priced, which it's amazing it sold off after the earnings because it's really good news. And their earnings, look at that, for the next couple of years are up in a straight line. It's less growth every year, which could be why the stock isn't appreciating as much as it could. But you can see this is a lot like the S&P 500, the QQQ. It's oversold at the bottom of its trading range. It's the perfect time to dollar cost into that stock if you're interested in it. And it's undervalued too by half. So even if it drops by half of where it's at right now, it's at 124 right now. If it went down to $60 a share, you have a margin of safety because it's already worth, according to our math, our simple math, it's already worth $248 a share. It's 124 right now. So even if it went down a half, you still have a margin of safety where it's still half priced. All right, that's a good little exercise. Um, okay, so let's look at some of the stocks that are on our watch list that are up and down this year. You can see Tesla, they had a good run from November when the president was elected, and they just gave that back. That's all that 22% is. Um, you see Nvidia is down 10%. Google's down 10% this year. Microsoft 5%. So all the big tech stocks are totally underperforming the rest of the market. And they call it the lag 7, LAG 7 instead of the MAG 7, but I wouldn't count them out. Um, Let me see. The ones that are doing the best are T-Mobile, Starbucks, Abbott Labs, stocks with paying good dividends and healthcare financials. And oh, it's good to look at that. Walmart's actually up 10%, even though they went down on after the earnings. A lot of high-paying dividend stocks are continuing to do good in this environment, such as Philip Morris, no, Altria, and let me see, Procter& and Gamble, XLU, Pepsi. Okay, so let's go look at. We already mentioned Trump said that there was a 10% tariff on China on Friday, so that's why the stock market. That's a good reason why the stock market sold off. And that's not going to be the last one. We're going to have 4 years of this, so you got to be like super ready whenever this happens again. And a lot of times, good companies like the ones we're following, they can adapt. They're not going to like sit around while they're losing money on China imports. They're going to get their stuff from Vietnam and wherever they have to avoid the tariffs. All right, so I just put a couple of charts of interest up. A lot of times, whenever stocks are in downtrends and you see it break out of that downtrend, sometimes you start a new trend going up. This is Amgen. Let's look at BA. This is Boeing. I wouldn't buy the stock because of the fundamentals, because they're very inconsistent. But you can see they've broken out of their multi-year downtrend, and they're starting to go up a little bit. They pay a dividend. They're a little bit oversold right now. So um, I wouldn't buy it just because they have quality control problems and um, they have an order backlog, but they just can't make their planes in a quality control way and in a way that they can have confidence by the customers. All right, let's look at a little article that came out. As I mentioned way at the beginning, let's look at this. Okay, we said at the beginning of the year, revert to the mean, healthcare, telecom, financials, energy, and utilities should outperform this year. I thought it'd be good. I saw an article on the top healthcare stocks that are undervalued, and I thought it'd be good to go over some of them. We, of course, have been going over Eli Lilly for like a year and a half right now, but these are some of the other stocks that this company thought was undervalued. Let's go over and see what they are. Okay. Um, NVO, this is Novo Nordisk. They do Ozempic weight loss drug, and this is Biogen, and then Merck. I thought it'd be interesting to go over some of these stocks just to see if we can find any um, stocks that haven't appreciated yet, that have been oversold for a couple years. One of them is Merck. Merck is a company that sells, they're a pharmaceutical company, and you can see right now their PE ratio is around 9, which is really low. Their their PE ratio is really low. They're usually double that. So sometimes whenever you see um, a stock with a PE with a really low PE, you have to compare it to how they traded for the past 20 years. This is a really old company. They've traditionally traded at like 18 PE. So they're almost half off of their normal what they trade for. Um, their market cap is 226 billion, and their profit margin is really good at 26. That's double what we're looking for, and their return on equity is 41. That's four times what we're looking for. Um, some of their problems right now is they have a drug called Keytruda that's going off patent. That is like half of their. It's the best selling drug in the world, and they're going to lose their patent on that in 2 years. That's half of their sales. So they've been going down for that as their main reason, but they're trying to replenish their pipeline with other drugs. So this is a lot very similar to AbbVie in how AbbVie had that same problem with Humira, and they bought a lot of companies to get access to drugs to replenish that pipeline. And you can see, let's look at um, AbbVie just for fun. There it is. Okay, we see AbbVie is now on like an uptrend. It was in a downtrend for a good portion of the last couple years. Um, let's look at AbbVie's 10-year chart. A B, hold on, ABBV. Okay, so we're waiting. Okay, so we're looking at a stock with a very similar, let's look at 5-year chart of AbbVie. It's taking its time. Okay, let's see. Okay, we had this stock was like trending for the sideways for a good couple of years since 2022. It basically didn't go anywhere because there was a drug going off patent, and that was a good portion of their sales. And they basically recently broke out of this. They see that this was like the level, the maximum level, and they couldn't break out of that. But only it wasn't until this month that they are starting to get some of their new drugs to take over. And that's exactly the scenario that Merck is in right now. So what CFRA says that there's limited downside potential at current valuations. This is an example of margin of safety. Whenever you have a stock that's going down and it's in a downtrend, it's called catching a knife, falling knife. So it's very dangerous, um, when a stock is going down. But I'm thinking the stock is a 4% yielding stock. This could be a portion, this could be a part of my dividend portfolio that consistently will give me, relatively higher dividend over time. And um, and it's in a drug sector. We know the drug sector this year is could be outperforming because it's been bad for the last 2 years, the sector. And let's look at what CFRA says. They said that it's undervalued by 10%. They said its real value is around 100. And let's look at what Morningstar says. They said that the price to fair value is 0.85, meaning it's 15% undervalued. They think it's worth $120 a share. So, okay, so we have this is like a contrary pick right now because a lot of people are not that interested in drugs because they haven't paid they haven't been going up like the tech stocks. But we're going into a time in the stock market where people are going to want to get conservative. They're going to want to have a stock that's um, safe, pays a dividend, and it's undervalued. So I think we have um, this could be a stock to look at for like the dividend part of your portfolio. Okay, let's look at some more of the stocks. Um, let's look at NVO. NVO, Novo Nordisk. They do Ozempic. They are also in a downtrend in a major way. Um, but you can see Merck. Let's look at Merck first. Merck is in a downtrend. You know, it's overbought right now, and it's trying to break out of this downtrend. We don't know if it's going to continue to go down. Um, if you're investing in a stock like this, it seems like it's undervalued. It's called a value trap. We don't know if this will continue to go down or not. For me, I see like a 100-year-old company that's consistently paid dividends that seems like it's undervalued. But you can't put a whole lot of credence that this is going to break out of this downtrend. So you have to buy just a little bit if you're interested in it and hope it goes down. And I like to look at it like if it's 92, if it goes down to 70, then make a second position. And that is how I dollar cost into a stock that looks like a falling knife, that looks like a quality company. So, well, only time will tell if this is a good time to buy it. But um, if you dollar cost, that at least allows you to take advantage of lower prices. Um, but there is a risk. There is an execution risk for this stock. If they don't have a stock, they don't have a drug that um, takes over half of their sales. If they don't have a drug to replace their Keytruda cancer drug, then they might just keep going down to the point where they're not making as much money. So it's a little bit of a risk. So we'll see. But they're a really old company. I'm sure they're smart enough to get drugs to replenish their pipeline. Okay, so we'll see about that one. Novo Nordisk. Let's look at what the Morningstar says about that. They said they're fairly valued where they're at right now. So that's not a very compelling thing to look at. CFRA basically doesn't give an estimate of fair value on this one. A lot of times they punt whenever they're doing research on foreign companies. Um, so what CFRA said that Ozempic and Wegovy, the two major stock drugs of this company, they are in the second round of price negotiation with the government. So the United States government is making a list of stocks that are super overpriced, and they're trying to bargain with the drug manufacturers to lower the price. And we'll see what happens, but that could really affect their profitability. Um, they're the market leader in the obesity market, benefiting from the first mover advantage. Everyone knows about Ozempic. It's a name brand right now. And they do have some experimental drugs such as obesity drugs in the pipeline. So that could help the stock. I'm not interested in it because it doesn't seem. I like Eli Lilly because they have a superior product right now. Their drug trials show that their drug is a lot more effective than Ozempic. So, and also Eli Lilly is making manufacturing plants that this company is not. And so it looks like this company could be falling a little bit behind Eli Lilly. So I'm not going to invest in it, but it was good to go over this. You can see that their profit margin is good at 34 and their return on equity is at 80. So that is really good. Um, their PE is at 23. So let's look at their estimates going forward. Their PE is 23, so they're about 1.15 times overvalued. If they're growing at 20%, Seems like you average these out, it's around 20%. So, so that means there's just about fairly valued, overvalued a little bit. Um, okay, so let's look at, in general, I shouldn't have put this there, but in general, there's nothing exciting about this right now. They have huge competition in weight loss drugs, and um, a lot of times, if you have a choice between two stocks and one seems like it's a better situation like Eli Lilly, I'd rather choose that one. Um, you can see that Novo Nordisk is in a huge downtrend. They're touching the top of its downtrend. It's like catching a knife again. Whenever a stock is in a downtrend, unless it breaks out of this, it's still in this downtrend. It's overbought right now and definitely not a good time to buy. Um, there's a story about Grantham. He's a very famous investor. He predicted a couple of the crises, the financial crisis and the dot-com crisis. He's saying that a meltdown is coming for U.S. stocks, and he's putting his money in stocks which are very climate change stocks, biofuels. Um, it's very dangerous to do this because Trump could very easily turn the sector over because he likes oil and he doesn't like renewables. So it's very risky for him to put his money into climate change stocks. He thinks that there could be a 50% drop in the stock market. But oh no, he oh I highlighted this because he's been negative for quite a while. He's predicted the last 2 years that we'd have a 50% drop, but we didn't. So um, there's a saying, a broken clock is right twice a day. That's whenever we didn't have digital clocks. And in other words, if you cry wolf too much, then people don't believe you anymore. And this guy's been saying that for a long time. Um, he thinks we're in a mother and father of all super bubbles right now. What I do is I try to see if a stock is fairly valued. Look at the peg ratio, look at and make sure if it's overvalued in a major way, then it could be time to start reducing it. But it's not a reason. This crash prediction is not a good reason to sell. I think a good reason to sell is, you have an internet bubble where everything is going up like crazy without earnings. Um, that is dangerous. But right now we're thoughtfully going through NVIDIA's earnings, looking at what their projections are going to be, and we know it's undervalued. Um, that's what I'm going with. If it does crash, then that's part of being an adult investor. You have to put up with that. Um, so you can read this. I'll send this along with my notes. But he also said, don't get it sucked into cryptocurrencies. He says they produce nothing. They're just speculative. I mean, I agree with that. And he's a very smart guy. So we have to keep in mind that, and always we have to do our research. If the economy's contracting, we have all these pieces and puzzles we have to, as an investor, keep in the back of our mind. If they come together to us, like the stock market's going to go down, then we have to make sure we're ready for that mentally. Um, Another guy, Steve Cohen, the owner of the Mets, he says brace for a significant correction. So we have multiple people saying that there's a slowdown coming. You have a brew of sticky inflation, slower growth, austerity in the government. I wouldn't be surprised me if we have a significant correction. And this guy is smart. He runs one of the largest hedge funds in the world. He owns the Mets. He's a billionaire. Um, you gotta you gotta take all these as hints, um, canaries in the coal mine, that if you're overextended right now, that you have to start paring back and getting a little more conservative. Here's a little story about Kathy Woods. She mentioned five crucial technology trends. There's a video you can watch if you click this link. There are five major innovative platforms. One is robotics, energy storage, artificial intelligence, blockchain technology, DNA sequencing. And I listed the stocks, some of the stocks, robot stocks and some of the DNA sequencing stocks. Artificial intelligence, we know NVIDIA, Tesla, all the stocks, the chip stocks that make stocks for that. And um, she mentioned Tesla is in robotics, energy storage, and artificial intelligence. That's why she has the huge position in Tesla right now, because she believes that Tesla is the future. They're actually coming up with um, the products that are going to be crucial technology trends. All right. Um, this Michael Saylor guy, he's very reckless. I mean, that's the word I have for this guy. He buys Bitcoin on margin. He says, sell a kidney if you must, but keep the Bitcoin. That was what he said this week. I mean, this is pretty ridiculous. Um, Bitcoin doesn't have any value, and Charlie Munger and Warren Buffett both said that stay away from this. So don't get sucked into it because even if it does go up, it's the greater fool theory. Um, if there's something that's worthless and people bid it up, you have to be willing, you have to have a greater fool to buy it. And that usually doesn't end very well. Um, let's see. All right, so that was what I had to say for today. I hope you had a good week, and I hope you have a good week next week. And I'll see you all next time.